Started.
Okay, thank you. Good afternoon, everyone. Hope you are doing well. Um, so let's get onto it. So today's topic you must have seen rebalancing and equalization in private equity, which is very important topic. As the people working in the private equity sector, they know the significance of private equity equalization and rebalancing in the private equity world. So before dwelling into that, I would like to introduce myself. My name is Sami Owais, and by qualification, I'm an MBA postgraduate, and I have completed like intermediate level of company secretary. Good number of years of experience into the industry. Worked for multiple fund accounting industry, mutual funds, some part of the hedge funds, and predominantly into the private equity sector. Okay, before I go into the topic, I quickly would be talking about this NGO, which I am a part of. I've been a part of for a long time now, which provides the platform for the speakers to get connected with the job seekers and the students. Okay, so Career Guidance Council started 15 years back with an aim to provide guidance, uh, teaching, giving training, basically just to bridge the gap between the academics versus your company's expectations, basically. So we have like registered into 2008 and a non-profit one organization. We have around 200 plus active volunteers around the globe. Uh, in the Gulf, in the western side, we have volunteers working there and still participate in our programs through online. As I mentioned, it provides platform for the students or job seekers to connect with the professionals. So that's a basic aim of having this NGO in place. And volunteers, what they do, they come here like what I'm doing today. We share our experiences, we share our knowledge, we guide the people, talk to them, and take their queries. And various programs have been decided, and we have conducted so far based on the needs. So as the technology and other things evolve, we also change our programs accordingly. So these are the various programs we do. Apart from doing our weekly sessions, we do programs in schools, colleges at the intermediate and degree level. These are the topics. I don't want to go into the detail, but you can quickly take a look at here. Then these are our weekly sessions. Happens on Saturdays and Sundays. Mostly Saturdays we conduct our online programs, webinars, and Sunday would be our offline. So those who are in Hyderabad, I would suggest them, if you are a job seeker or if you are a student, to come and take most of it, talking to volunteers and attending the sessions. I will share the details of the venues at the end of the presentation. And professionals also, if you think that you want to share your knowledge and experience as well as you want to improve yourself, you are more than welcome to come here and share your ideas, thoughts, and improve yourself and build your network. So this kind of like industry seminar also we conduct discussion panels, getting the industry experts like director level people, and which can help the students and the job seekers. Okay, we are now back to the topic. Somebody mentioned sound is low. Can somebody, some people can confirm if sound is good now? I'm trying to be louder.
Yeah, a
Yes.
little better, but if you could be closer to the mic, it will be
I'm very close, in fact. Let
okay.
me.
Okay, now it's good. Thank you.
Okay. Okay. The topic is rebalancing and subsequent flow. Not subsequent. The topic is rebalancing and equalization. So both those terminologies, right, would get triggered and become relevant with this thing, which is there on my slide now, which is the subsequent clause. So subsequent clause we need to understand first in order to understand the equalization concept and rebalancing concept. So first we need to understand The private equity fund, which is a fund where you have LPs, where you have the on the right hand side you have the investment where the private equity fund invest. So it so happens they don't take all the LPs or the investors in the one go. So multiple times, multiple LPs or the investors enter into a private equity fund. For example, today some new set of LPs joining. Today is the first day of the fund, and after certain months, some more people get excited or they show interest and they join the fund. And subsequently, it happens as and when people are interested, they keep joining the fund at different intervals, and each interval or each time people are getting added, that is called the subsequent close. So subsequent close happens when new or the existing investors increase their commitment. So it so happens sometimes, say some people are joining at the first close, and after a certain point of time, some new people are joining, or the old people who are the existing LPs, if they are like more interested, if they are happy with the performance of the fund, the way fund is going, and they are happy with the strategies set by the GPs, then the old investor or the existing investor, they can add to their commitment also. For example, initially I have invested or committed for 1 million, then later being I'm satisfied with the condition and how the fund is going through, I will increase my commitment to 2 million, right? So that is also part of subsequent close. So this as written here, this is very common in the private equity world. First they like introduce the fund, start the activities, start the operations, and they keep raising the funds, more funds or the more capital by adding more number of LPs. This is required and this is a part of it, but the more closes happens, the more complex it would be for the fund accountants. Okay, and if the structure is little complicated, you have like master feeder blocker kind of entities. In such cases also, uh, it becomes difficult to calculate such things, but that would be very interesting as well. And how we are getting to know what dates to use, what percentage to use, what would be the way of calculating, everything would be written in your limited partnership agreement. Is that fine? I want people to put it into the chat if you are able to follow so far. I want this session to be interaction. It's not should be like monotonous or the one way it's happening. Fair enough. Thank you for participating, everyone. Okay, moving on to what are the steps, like what are the things, or the what happens basically when a subsequent close happens. Three things happens there. One is that is our today's topic, that is rebalancing or equalization uh, comes up in the picture, and some calculation happens, some entries could be booked, and new LPs are like invited and they become the part of the fund. Second is equalization interest is gets calculated. We will see that also with an example. Profit and loss account also gets rebalanced. We may not be touching this part, but I will explain you what does that mean in the coming slides. Okay, rebalancing equalization. We are here now. So what happens? Like people are joining at the first date of the fund. When the fund launched, people started joining. What happens? Some people join at the later part of the fund. So people joining at the first launch of the fund will should not be ideally having the equal rights same as the people joining later. They should have something preferential, right? Because you are coming into the fund when nobody was there, and you become a part of the fund, and you have been a part of you have given some capital in the form of drawdowns, and some expenses were paid by the fund using your money. So you have put your money way before the other LPs came in. Okay, so that's where equalization concept come into picture. When it happens when a capital is called after a subsequent close happens. What does it do? It aligns all the investors as if they joined the initial closing. Okay, this is very important, or this is the definition of the rebalancing or the equalization. The whole purpose of doing rebalancing is to make some adjustment, make some calculation, book some entries. After that, after booking all these things, it is as if everybody joined on the January 1st. I'm taking very simple example of January 1st. Okay, so after this calculation and the booking entries into the system, when I pull out the reports, every one should be showing the same proportion into the fund as per their commitment. If somebody committed like 1 million, somebody committed 2 million, somebody 3 million. So everybody's proportion of the each of the items what we are booking into our fund, whether it is like expenses, whether it is income, any kind of profit return, any kind of distribution at later point of time when the fund is doing, the proportionate should be same and match as per the commitment. Okay, what it does, it ensures that each investor contribution reflect their ownership percentage. Same point what I have just spoken about. So what GP do? GP typically calls the capital as at the subclose, or they can call the capital later point of time as well. I will you will understand this point more when we go into the depth and look at the example. Are we good? Some more responses, little traction on the chat box, or any clarity you needed, just push your questions there, and I will take it. I have a my second eye on the chat as well. So if you ever feel you have questions, feel free to put it there. I want you to, at the end of this session, I want you to take most of it and understand everything. Okay, next important thing in the equalization thing is equalization interest or subsequent close interest. Remember the terminology. This is called as the equalization interest and subsequent close interest. So equalization interest or the subsequent close interest is paid by the new investors to the old investors as a compensation for they coming into the fund before them or the at the before time, and some kind of like opportunity cost, right? You must have heard this term, right? So same concept here also, because they came into the fund at earlier stage, so some kind of preference should be given to them. That is the reason they are being compensated now by way of equalization interest, which is paid by the new LPs to the old LPs. What happens, it compensate, as I mentioned, it compensate for the time gap. If the time gap is like of 3 months, some LPs came in uh, before and some LPs came in after 3 months, then this amount or the subsequent close interest, it is uh, compensating for that time gap. And how it is calculated, how much is the percentage, everything is defined in the LPA. And where it comes from? It comes from the new LPs, new investors, and distributed to the existing investors who joined in the first close or the prior closes. Okay. Often processed during the rebalancing. Yes, whenever the new people come, as we just discussed in the previous slide, whenever new people keep joining, rebalancing happens, then equalization interest also calculated separately and handled, and which is it may be given to the old LPs, and new LPs will bring in this amount apart from their actual capital call amount. Okay. Some questions I'm quickly taking. Equalization or rebalancing. If you ask me, for me, it is there is no difference. No difference. This is just a, using the different terminology. That is why my topic you can see it's like the same basically. Practical example. Yes, we will be developing into that shortly. Practical example. Yes, into it. If somebody is asking commitment, I will explain in the coming slide or when we move to the practical scenario. Any questions on subsequent close interest? Quick thing. Are you good? In very simple word or the layman language, it is called like people call it as a, it's a kind of like penalty old people, new people or the new LPs are paying for coming late into the fund and giving it to the old parties. Okay. The question: how many closes in a period? Uh, Mostly, it would be like uh, there is no restriction or number of closes unless the target would be when the fund starts, right? They set up some target that is called the fund size, say 100 million. So as long as they reach the 100 million, they can keep doing the sub closes. Okay, okay, let's move it. Okay, this is basically the PNL adjustment. This headline is not correct for this. So this is a PNL. So just simple example for this is again some new set of LPs came into the first Jan. One quarter happened, the NAV is calculated. So every expense or income happened during that period is allocated to the old set of LPs, right? So when we are doing rebalancing, one of the steps we need to ensure that we are doing rebalancing of the capital calls and the distributions, what we have just understood. This is in this step, as we are doing rebalancing or equalization of the capital call and the distribution, similarly, we have to do the equalization or the rebalancing of the profit and loss happened so far till the second closing happened, right? So typically reallocated pro rata PNL, we are talking about PNL here. So PNL typically reallocated pro rata, but may vary due to special investors agreement. Because what it's saying is basically if there is no arrangement of allocating expenses particularly to particular LPs, all the LPs would be allocated in the commitment ratio. What we call it as, okay, like as per the commitment you whatever the commitment you have given, in the same ratio all the PNL, that is your expenses or income or losses, would be allocated. Sometimes it so happens that some there can be some big parties or the HNI client, ultra network, high network individuals would be there. They may not agree to your expense terms, and they would say, "Boss, everybody is paying 2% management fees or any expenses. I may not be part of that. If you agree, then take me. Otherwise, I'm not okay with going ahead with the fund." So, in order to accommodate such people, private equity fund sometimes charge them less expenses comparatively. So, this is talking about that any such thing would be there that won't get rebalanced. Okay, I'll explain you more when we understand this using an example. Management fees are not usually reallocated because management fees is something given by the LP to the GP or the fund, that is very personal to the LP. So that is the reason management fees is not equalized or rebalance, because management fees, if you look at the calculation, right, that is calculated on the commitment of the LP. Okay, and that would be very individual to LPs and will not be a part of rebalancing. And this point you need to remember: new investors may pay fee from the inception to match existing investors. Basically, management fees is paid from the day one, irrespective of the LPs joining at any given point of time. Assume that any fifth, sixth close is happening in the next year, April. Then also the LP, new LPs coming in, they have to pay management fees from the day one, which is January 2021, 2025. Okay. Okay. Any questions so far? Now we have to move to the example. Before we move, quick questions. I want to take it if you have. Somebody saying management fees calculated on the NAV base. Yeah, it depends. It depends. Like if it is the calculating, it can be calculated on the commitment. It can be calculated on the NAV. It can be calculated on the like invested capital. There are different ways to it. Site letter and because of the management fee is not allocated. Yes, site letter is nothing but that's a special provision you are giving to any LP. So any different provision than the LPA, that would be a part of your site letter. So management fees may not be required the site letter. That is pretty much understood from the LPA itself that when rebalancing happen, management fees will not be a part of it. Is actual cash brought in by new LP? Will discuss. Impact on the NAV, we'll discuss. FOF fund receive equalization interest. Is it an income for the fund? We'll discuss that as well. What is the typical rate? We'll discuss. I think I have to start that because most of the questions get answered when I move to my Excel. So there is my Excel. Okay, fair enough. So, as you can see my screen, I am taking an example of a fund which is called Red Star. So, Red Star is my fund, uh, private equity fund basically. So, on the left hand side, you have the LPs, 1, 2, 3, 4, 5 LPs investing into this fund. And on the right hand side, this fund invest. So, investments, I always say investments, you can call it some companies or the fund admins, they call it as portfolio, some they call it as underlying funds or the underlying investments. So one and the same terminologies. So understanding the clauses, right? So number of people joined at a particular point that can be termed as close, right? So commitment, somebody was asking. So commitment is nothing but the assume that today is the first January and there are four people. I am launching the fund. I am the GP. I am the owner of the Red Star Fund, right? So on January 1st, I am starting this fund, and four people agreed. Four people agreed that okay, boss, we like your idea and we want to make the investment. Okay. The moment I agree and accept their commitment, then that point of time is called the first close or the initial close. And assume that after a certain point of time, say June, after 6 months, some more people or some more LPs, they like the fund, they like the idea, like they like the strategy of the GP. They are also interested to join the fund. They brought in some commitment. Then that point of time when the commitment is increasing, new people are joining the fund. That is called second close. Assume that two more people were interested, and later point of time in September they wanted to join. That is called as third close. Simple. And assume that one more thing happened, and in next year I got enough money, and in like 2026, uh, I have got two more LPs joined, and I got the amount what I was looking for. Okay, so this can be final close because whatever the target I have set a target of say 10 million, right? 10 million I set the target. So if I receive my 10 million commitment target here, then what I do the final close and close the fund. Like close in the sense I don't take more commitments from now on, and that becomes my final close. And all closes happens between first close and the last close is called as subsequent closes, right? Any closes happen between first close and the final close, they are called as subsequent close. And this is called as my fund size, like total uh, amount of money I want to raise it from the market from the different LPs. Okay, can you just type in yes if you are able to understand? I want to see people are listening and able to understand. I would request people to put relevant question what is being discussed so far, not the questions, random questions coming to your mind, because there are a lot of things we are going to discuss, and I'm sure that would be covered in the later. If those are not covered, then we can discuss. Fund size is AUM. Yeah, initially it can be called as AUM, not AUM, sorry. AUM is defined differently at different point of time. So fund size is the total amount of commitment I want to take it from the people, or the total amount I want to call it from the people. In simple language of company accounts, that is the authorized capital. Maximum amount I want to raise. Okay, fair enough. Okay, this is the first example. This is something I've created. Okay, so this is the first same example I'm taking so that we understand easily. So the date is January 1st, four LPs, A, B, C, D. Those are the names of the LPs. They have, I'm taking very basic examples so that we understand that is our purpose, right? So four LPs came in ABCD and they got the commitment, right? Commitment, he committed 10, 20, 50, 40. My total commitment is 1,20,000, right? 120,000 in simple words. So this is where I want to start my fund and doing the operations. So as you guys now aware, this is called as first close. I want you to don't concentrate on the other things which are there in slide. Just concentrate what I am showing so that you can be able to understand. I'll explain whatever is there in this Excel sheet today. Okay, so this is the first close four people, four LPs came in, and I got the commitment. Somebody was asking how much do we call or when do we call? My wish on the first I have got the commitment. I can call in Jan, March, April, whenever I want. So we are assuming on the first I have taken commitment from the people, and I have made the capital call on the first itself. So I am the GP. I will decide how much I want to call it as. Oh. Say for example, I want to call 10%, right? 10% I want to call. So how do I do that? 10% of the 10,000 is 1,000. Same 20,000 is 2,000. Likewise. So 20,000 out of 1,20,000 I have called as a part of first capital call 12,000. This is very simple example, right? Okay. Have you guys understood till here? I want maximum people to say or the uh, confirm their understanding on the chat. That's how I know if I'm going fast or if I'm going slow or you guys are able to understand. Somebody is asking what is capital call. So this is the just a commitment people gave. This is just a commitment people gave. Like whenever you boss the GP, whenever you call me, I can give you the maximum amount of 10,000. Right? So nothing is going from here. No cash is going out when we say something commitment. This is the cash part. Out of 10,000 commitment from this LP, I am calling just 1,000. Okay. Hope I am able to give you an answer. Okay. So far everybody is good. Everybody is happy. They are fine. So these are this in this example we are discussing the first type of uh, calculating subsequent close. Okay, this is very basic example. Then we'll move to example number two. So in this example, how much we have called? Can somebody type in there from the first set of LPs? How much I've called? No, percentage. I'm asking if somebody is not haven't got the question. 10%. Okay, fair enough. Thank you. So I've called 10% from the first set of LPs. Okay, after a certain point of time, say in June, that's what we fixed our date. Three more people were interested to join the fund, and they got some good amount of commitment. Somebody E got 50,000, F got 40, and G got 5,000. And as I told you, new people join and they get the commitment. That point of time, if I am stopping there and putting the cutoff, that is called second close. Simple. I'll give the simple definition to the people about how to understand when the close is happening. Whenever you see commitment is increasing, that is your close is happening, right? So what was my previous close? It was 120. Now 95 more got added, right? Now my total balance is under commitment is 215,000. Make sense? Okay. So in this method, in this example, what the fund manager or the GP does is they don't want to get into the complications. So what they do is they do something very simple. Whatever they called from the previous LPs, that was 10%, they will call the same amount of capital call from the second set of LPs also. 10%, 10%, 10%, 95, 9,500. That's it. But if we stop here, if you stop here, then again the old people will not be happy. They would say, boss, we are into the fund and you are just calling 10% from them also. We also give 10% and they also 10%. The deal is not good. This is not the way to move forward. So what they do is, okay boss, okay, don't get angry, we'll do something for you. So they make the arrangement for calculating subsequent close interest. In this example, guys, don't get confused that why I'm not talking about rebalancing and all, because we are talking about one of the basic calculation which can happen. So what they do is, for making some arrangement for the old set of LPs to compensate, they will get some amount extra from the new LPs. For that, they do one simple calculation. The calculation is the amount called by the from the new LPs, and the difference of number of days between the first and second call divided by 365 and multiplied by the preferred return rate. So some people were asking what is the rate of the subsequent close interest. It is usually the same rate what we use in the for the preferred return or the hurdle rate, or it can be defined separately differently into your LPA. For this rate, you don't have to analyze, you don't have to research anything. It will be clearly given into your LPA. But most of the time it is equal to the preferred return, preferred rate, right? So let us analyze this formula. What all the things we need for the formula? So there are a couple of things you need in order to calculate the subsequent close interest. First, capital call amount from new LP you need, and you need number of days between the first capital call and the second capital call, right? Which is January and June, the difference. Those who understand due date, you have to take the in the practical scenario, you have to take the difference of the due date from the first call and the second capital call. And number of days in a year, usually we take 365 and the rate. So these four ingredients basically you need in order to calculate the subsequent close interest, right? Look at this now. First, I am taking the capital call as I mentioned here. Then bracket open, I am taking the difference of number of days which I have already calculated here. Simple formula, this minus this will get you the number of days difference, right? So capital call amount is 11. F11 is nothing but my difference of number of days, right? Which is 151. And the F20 is my number of days in a year, that is 365. Then bracket close, I'm multiplying with the percentage. Very simple formula. Very simple formula. So don't get next time when you do uh, go to your desk, just observe the formula or try this formula. You will be most likely match. This is how it is done. Are you guys with me? Are you guys able to understand till here? Any questions on this thing, this topic? Awesome. I would like to take this question. Supraja says in the subsequent clause, the contribution is not collected from the LPs. Yes, depends. Again, depends. What kind of subsequent clause GP is doing. There are cases when they can call from the old LPs also, and in order, most of the time they don't call because they don't want to complicate the things, so they keep it separate. So when the subsequent clause, like subsequent close LP comes into the fund, they just do the rebalancing part and do this rebalance, equalization, interest calculation, and PNL rebalancing. So a lot of things are happening right at the back end. That is why they usually don't call from the old LPs in this subsequent close. Okay, so I have collected 314 from the new set of LPs. Now the question comes, how should I divide that? What should be my criteria? So criteria is very simple, boss. Criteria is this is the total amount you have, and you know what is their proportion. Whole proportion is there, right? Simply you need to divide the total subsequent close interest among all the old LPs in their previous ratio. I'll show you that how it works. So look at the formula G14. G14 is nothing but G14 is my total subsequent close interest I have taken or calculated from the new set of LPs. To that, I am dividing that the same amount with the taking the proportion of the commitment of the old LPs in the old ratio. Example, C10 is the previous commitment given by the AA, which is 10,000. I am dividing that with the previous or the first close total. I don't involve them when I divide this subsequent close interest because who is eligible to get the subsequent close interest? Can you guys type in quickly? Who is eligible to get the subsequent close interest? I want everybody to type your answer. Don't go with the majority. Majority can be wrong sometimes. So if you have your answer, do type in without assumption. You guys are right. Everybody has given the same answer. Old LPs. So when I am giving to the old LPs, then it is understood that I have to divide that into the old ratio, right? I hope you guys agree. And if you look at all the formulas, I have given from there, right? Simply 314 I am dividing among old LPs in the old commitment ratio. Awesome. Okay, moving on. Now there are two things we need to understand. Now this after rebalancing happened, like basically nothing happened in the rebalancing. They have just called the 10% of money, and but they have calculated equalization interest, right? So new LP, when he gives amount to the fund, he has to give, not only give his 10%, but also he is liable to pay this equalization interest also. So when he gives the first capital call amount to the fund, he will give 5,000 plus 165 also. He has to get that as well, right? So instead of getting 5,000, he will get 5,165 to the fund, and the other LP will get accordingly 4132. His actual capital call amount is 4,000, but he is getting extra 132, which he is liable to pay to compensate to the old LPs. He is getting some extra amount. Right. Let's see what is the impact to the old LPs. Old LPs, they are not bringing in anything at this point of time. Whatever they have given, 1,000, 2,000 as the first capital call, that remains there as usual. Only thing is they are now eligible to get this amount back, right? By way of what they are getting in the form of equalization interest, they are eligible to get this back. Now the question comes whether it can be given, because amount usually would be very small when compared to their capital calls, right? So there can be two options here, right? Either the first option is either to return amount there and then itself, collect this extra amount from the new LPs and give back to the old LPs. That's a one way of doing, which is not usually, unfortunately, not followed. The reason is this amount being very small. Second option is subsequent capital call happens, right? In this case, they are calling this as the first capital call, and this is in case they are calling this as a second capital call. Then, when they are calling third capital call from both of them, then they can adjust that. For example, in the third capital call, you are calling 100, 200, 300, example 500. I'm taking just to be in line. Assume that this is my capital call. I am going to call in the future. So what I do, instead of uh, calling 100 from him, I will deduct that equalization interest which was sitting with me with the fund. I will deduct that and I will call some less amount from him, from the old LPs. Any questions here? Let me know if you guys understood this concept which I have just explained. Can't we adjust subsequent close interest from commitment itself? What do you mean by commitment itself? I didn't get you. Sorry. Okay, very interesting questions, Prakash. Will it be inside the commitment or the outside the commitment? Maybe I'm connecting to the previous question. Thank you. I got your question also, Rajesh. Yeah, that would be a out of commitment. Yes. Thanks for bringing in that question. So whatever the this extra amount they are getting, right, that should be a over and above this amount. They should not say tomorrow, if I'm calling here 45,000 tomorrow, this LP should not say, boss, I've already given you 5,165. Then I'll pay you, say, 50,000 minus. I can pay you only 44,000. The GP say, no, 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 hold on here. You have paid me, or you have brought in the 5,000 only. This extra what you have got, that is not for me. This is something you are compensating to the old LPs, not to me, right? So therefore, actual amount you have to bring in is still stays at 45,000, not 44,000. So this is something, whatever the subsequent close interest happens, they have to bring in extra out of their commitment. Okay, okay, fair enough. Okay, I hope this example is clear so that we can move to the next slide, which is again interesting. You guys can put in if you are we are good to move to the example number two. Meanwhile, I'll read out the questions. Before second close, if there is any distribution, will it be adjusted? Of course, 100%. If any thing happened before, that has to be adjusted for sure. Generality, I'm not covering it today in the interest of time. Maybe some other day we can concentrate on the general interest. That is going to take some more time. Okay, I understood. Like we are now good to move. One more question, then I'll move. How do you book equalizing expenses in the fund? If it is feeder master, where do you book it? See, all this we are talking about the LPs. So wherever the LPs are sitting, this equalization interest, everything happens there, right? Because we are talking when we are seeing subsequent flows is happening. We are talking subsequent flows of LPs. So wherever LPs, wherever the entities LPs are sitting, that happens at that level only. If LPs are not interested to invest in third floors, will they pay off? Third floors, what they have to pay off? Usually they don't have the choice that I don't want to pay the third capital call or something. When they have committed, they are liable to pay that amount. Okay, I'm moving to the second example, which is little complex and you need to put little more efforts on. Okay, fair enough. Same example, 4 LPs, 120,000, and 3 LPs joined, 95,000. We are all set. Same example. And here I change my example to 10%. I will make that correction here as well. You can see if I'm changing one uh, formula, it is having all the cascading effects, everything is getting changed, right? So it is very significant calculation where you need to be very careful while doing this. And if you understand the basics of it, then of course you can understand all the formulas lying there. Same thing, 10%, 10%, 10%, 10%, that is making to 12 for 12,000 from this setup. So till here we are same. There is no change. The change comes when these LPs are entering, right? Okay, so till here I can say everything is same. Now this new set of LPs join. Okay, how we are going to treat in this method? Okay, what they do is in this example, so till date they will see till date whatever the I have called, what they do is they just divide this instead of calling new money from the new people, new capital call from the new LPs. What they do is whatever they previously called, they will divide that into new ratio now, right? When I say new ratio, that is old commitment plus new commitment, which is to 15,000. I will divide my capital call into that ratio in the new proportion. So my capital call amount is 12,000 till date. So what I do is I divide that 12,000 in the new ratio. Earlier, the ratio of this LP was 10,000 divided by 120. Oh, sorry, where it is going? Okay. Yeah. So earlier ratio of this LP was 10,000 divided by 120. Now the ratio has changed. Now what I am doing is I am taking the total capital call amount and dividing into the with the total ratio including the new set of LPs also. So this 12,000 now getting divided among 7 LPs, right? So 10,000 divided by 215,000. 12,000 I am dividing into the formula is very simple. 12,000 which is freezed and the ratio for calculating the proportion I am doing taking this divided by this very simple formula. So ideally, in the previous, when I called previously, I was just calculating direct amount, like 10% on my commitment, 1,000 this LP gave. Now, as per the new ratio, new proportion, this LP is supposed to give only 558, right? He is, as per the new ratio, he is not to give 1,000 but rather only 558 he has to give. So what I do is in rebalance I'll do the rebalancing. Okay, before I go there I'll show how it is looking for the new LPs. For the new LPs it would be same, divide this previously called capital in the new ratio, which is 50,000 by 215,000. Any reason why these amounts are very big? Here I can see 558, and here I am seeing 2,000. Can you guys put it your answer in the chat? Why these people are getting more? Where I'm seeing these LPs are getting only 558, 1,000. These new LPs, why they have to give more? No, 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 no. We have not talked about interest so far. So whoever is thinking it is interest, that's not the right answer, right? Just take a look at again the Excel, not the chat box, and give your answer because this is very important. Because we have not till now we haven't talked about subsequent close interest. No, 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 no. Still, I'm getting some not good answers, not right answers. Rather. Okay, commitment is higher. Simple. The answer is very simple. Commitment, high ratio, right? So it is nothing to do with the second clause, first clause, interest, subsequent clause, interest, equalization, nothing. It's as simple as more commitment, they are getting more proportion. Because what I'm doing here, I'm just calculating, I'm just dividing this 12,000 among all the LPs. I've not touched any calculation, any difference of the dates, any rate, nothing, nothing so far. This is just a plain calculation of dividing the 12,000, right? Because this LP gave only 10,000 commitment, and this LP is giving me 50,000 commitment. So obviously, it would be the like 5 times higher for this LP, right? I hope those who gave answer they understood the point now, right? Okay, let's move. Any questions, guys, or we are good to move because this is very important. We need to understand that. Just a moment. Okay, no questions, surprisingly. Have you guys understood? Just put in your thumb or okay something. So as I told you earlier, no difference between equalization and rebalancing for me. I don't know how people are defining, but yeah, in terms